So, Assalamu alaikum. Welcome to the 20th KSB webinar. Today we are going to talk about sovereign debt, and we're delighted to have Dr. Syed Muhammad Ali Abbas join us from IMF, from DC. He's the author, editor of a book called Sovereign Debt, along with Ken Drogoff from Harvard University. Ali Abbas, I'll speak in Urdu for the audience in Pakistan. Ali Abbas, I have always learned a lot from every interaction with him, whether it was in Istanbul or Ankara or at Oxford or in DC. In fact, and I'm not the only one in that. In fact, Ali Bhai, I still remember, I don't know if you do, but you told me when we were traveling from Ankara to Istanbul, that when you worked at KSB, a foreign fund manager asked you about what's the total market cap of Pakistan? And that's the question you asked me. And when I answered that, I think I answered that correctly. So you said, that's well done, because you said somebody asked you that question. So now whenever I do ask that question to whoever I interview, and whenever I do, I think about you. That's just one of the things which I've learned, but I've learned immensely. So I'm really delighted that you've taken time out to talk about your book for us. And the recording of this webinar will be available on KSB's website, ksb.com. It will also be on our MOOC, which is ksb.teachable.com for students. There are more than 1,500 students who are enrolled in that course now, and around 70 have already completed. So that actually makes it the largest business school in Pakistan, because LUMS and IBA don't have that many students in their business course. Dr. Ali Abbas, the Rhodes Scholar, he was at Oxford, then he moved to IMF, and now recently he's become the mission chief of IMF for Jordan. And Ali Abbas, I thank you for taking your time for this call.
Thank you, Ali Farid. It's very kind of you. Assalamu alaikum, everyone. बहुत अच्छा लग रहा है कि अपने पाकिस्तान related जो हमारा economist या financial professional sector है, उससे बात करने का मौका मिल रहा है. तो KSB was my first job after my MBA from LUMS. So I have fond memories, and the reason why I told you about that market cap question was that when I was asked that question, I got it wrong, and and I learned a lesson from that whenever you're working on some area, you need to know the big numbers in that, of that subject. But this is just a reminder that we learn a lot from our mistakes, and that's how I've approached my own career. So this book, before I start, I have to say that the views expressed in this presentation are my views and do not necessarily represent the views of the IMF, its executive board, or IMF management. This book, Sovereign Debt, which I will talk about, was 10 years in the making, from thought to collecting the people who would contribute to actually publishing it. And again, one advice for academics out there: these things don't happen quickly, but you need to start thinking about them quite early, and inshallah, they will come to fruition eventually. So Ali, you can post the slide. You can start showing the slides.
So I'll share my screen now, and I'll open up the presentation.
Okay.
Is it on the screen now?
Yeah, but you should put it in play mode. Yeah.
Gee, I'm trying that. Okay. Done.
Okay. So maybe scroll down to the next slide. So what's on offer? This book is a compilation of contributions of the world's leading sovereign debt experts. It's a resource for specialists and non-specialists alike. It's not fully light reading. It is a guide on sovereign debt, so some familiarity with the issues is helpful. But it does appeal to a broad audience: students, policymakers, financial and legal practitioners, especially policymakers, because I felt that economists tend to sometimes overcomplicate the presentation of their ideas, in equations or regression models. But you really need to present the distilled wisdom of this to policymakers in simple language and charts. And if you do that, it can actually enhance and improve decision making. It provides a comprehensive coverage of sovereign debt issues, covers debt management, debt sustainability, how to reduce debt, sovereign debt restructuring, and connects history with the present. So it's quite a broad ambit that the book has. And it has extensive use of real-world examples, and it links theoretical debates, the policy debates to theory and theoretical insights. Turnover. So the book has been endorsed by several policymakers. We ran it by a few ministers of finance, governors of the central bank. We have some governors of the central bank. Our own Raza Bakir is one of the chapter authors. But in general, we got very good feedback that the book strikes the right balance between covering the complexity of the issues, but a simple, clear presentation for policymakers. Let's go on. So this is the structure of the book. It has 9 chapters plus an appendix, which I wrote with Ken Rogoff on sovereign debt data. Both of us are passionate about data, and we put together an appendix on that. But basically, if you look at this outline, you can see that it covers the full cycle of debt. So the first chapter is just an intro on public debt through the ages, how debt started. The last century is covered extensively. I'll come to that. Second one is, what are the concepts, definitions, and composition of public debt today? And then we have the full cycle of borrowing, the motive to borrow. Why do governments incur debt? Public debt sustainability. When does debt become too much? How do you manage debt? How do you reduce debt from a high level without defaulting? And then what if you have to default? What are the issues around that? And if you do default or undertake a restructuring, what actually happens in the restructuring? And then finally, challenges ahead. This came out at the end of last year, so it's pre-COVID. But I can tell you that many of the challenges identified in this book are actually playing out now, given that sovereign debt levels have elevated quite a lot. And we can see some of these things, in the issues that countries are facing today. Please go on. So, as I told you, this book is about the circle of debt, how and why debt is created, which is birth, how debt should be managed in a safe and sustainable manner, rules of conduct, live healthy, and how debt default death should be resolved in an orderly fashion to provide resurrection. So that's how we conceived the book. It provides good guidance for the ultimate search for living eternally with debt. Okay, move on. So what I will do now is take you maybe briefly 2-3 minutes per chapter. It will take me 20 minutes, but it will be useful. The first chapter looks at the broad sweep of history of sovereign debt. And it asks the question, why did sovereign debt actually start? Why did governments need to borrow? As you know, governments can tax citizens. So, from a theoretical perspective, it's not clear why they would need to borrow from citizens. And the truth is that initial borrowing started in the context of wars. When countries, they did tax their citizens, but they needed more money. And so the first borrowings, the first debt contracts that we find are in the 100 Years' War in the UK, where the UK king or monarchy borrowing from Italian bankers. And so that's the first transactions that we see recorded. Basically not borrowing from your own citizens, but borrowing from abroad. And then gradually, as the governments became more organized, their legitimacy increased, debt was increasingly used to finance infrastructure and current spending rather than just wars. And it was increasingly borrowed from domestic citizens and not just foreign ones. This chapter also looks at some of the great buildups and reductions in debt over the last century. And the organizing framework for that is this equation that you see, which is the change in the debt to GDP ratio is a function of three things. It's R minus G, where R is the interest rate on debt, G is the growth rate of GDP. So you take that differential, we call it R minus G, or interest growth differential, multiplied by the level of debt. So that's one factor, that's called automatic debt dynamics. That pushes, if R is greater than G, then it would push debt up. Then you have the primary balance. If the country is running a primary surplus, that would tend to push debt down. That's why you see the minus sign there. And then you have the currency depreciation times the FX debt to GDP, which again pushes debt up. If you have a large share of FX debt and your currency devalues, the burden of that debt rises. So this is a simple equation which combines the various factors in play. And what we find in studying, what the authors find in studying the past is that if you have high debt and you try to reduce it through aggressive fiscal tightening when the economy is fragile, what happens is that growth dips a lot. And that causes R minus G to rise, and actually it can offset the benefits of the fiscal tightening. And you can see in the table on the right, you can see that in the Great Depression, the first row, the interest rate growth differential added 108%. So in terms, there was a big increase in public debt, and most of it was coming from the interest growth differential, not much from the primary deficit. In fact, the primary deficit was, the countries were trying to keep their books balanced, but in doing so, they actually might have pushed growth much lower and caused the interest growth differential to rise a lot. And then the second lesson that comes through is that countries have also resorted to inflation and financial repression to try and lower the R, the interest rate, force holders of government debt to take a lower interest rate, less than inflation, through regulatory means and others. But the result of that is that you can, and that's not shown here, that's in the book, that you can find that in these countries, share of FX and short-term debt can rise because savers no longer want to put their money in fixed rate local currency debt because they know the government could inflate it away. So that's what we see in some cases in World War II. And maybe Pakistan is also an example. The government has over the past several decades, whenever it was hit with a crisis, resorted to devaluation, higher inflation. And the country has had a large share of domestic debt, but generally very short term and repriceable. And plus it has, FX debt. So when you have, when you do resort to inflation and financial repression, it can help in the near term, but they can be longer term trade-offs. So anyways, maybe we can move on. That's some lessons from the first chapter. The second chapter is about concepts, definitions, and composition. It asks the difficult question of what exactly is sovereign debt. And it shows that there is a surprisingly large variation in definitions and how the choice of institution, instrument coverage, or valuation can lead to very different numbers. So the chapter actually starts by showing two very different numbers for the US debt. One is 20 trillion, which is close to the official number. The other is 75 trillion, if you also include the pension-related contractual obligations of the government. So, and then other, SOE obligations. In Mexico, you have the debt concept that covers their oil company, Pemex, but it doesn't cover the liquidity paper that the central bank uses to mop up liquidity. In Brazil, they include liquidity paper, but not their main oil company. So you have these differences across countries, which make comparing debt levels quite difficult across countries. One innovation in this chapter is that the authors present also sovereign debt as part of the overall balance sheet of the government. And this is a chart which shows, so the diamonds that you see show the level of public debt to GDP. The negative sign is just that it's a debt position, not an asset position. So all of these are debt positions. So for example, for Portugal, it's close to minus maybe 110 or 110% of GDP, the diamond there, the first country in the chart. But then the horizontal lines that you see, the black lines, are the net equity or the net worth of the government. And you can see that for countries with quite similar gross debt positions, like the diamond may be in the same place on the vertical axis, but their net equity is very different. So take Norway, for instance. It has about 50 or 40% of GDP of debt, but its net equity or net worth is 400% of GDP. And similarly, you can see a whole range of countries on this. So this approach of the overall sovereign balance sheet, which includes the broader state-owned sector, banks, pension liabilities, and central bank, is quite an interesting concept that's coming up. Let's move on. So then the circle of debt. You know, why do governments borrow? And the chapter identifies two sets of reasons: good reasons and bad reasons. And there is ugly in both of them. So, but the good reasons are basically tax smoothing and countercyclical demand stimulus. When the country is hit with a negative shock, which opens up a fiscal deficit, the government's reaction could be to raise taxes, but that can have a very negative effect. It can have a distortionary effect on labor supply, on firms' investments, and it can push the economy into a deeper recession. So by borrowing during that period, it can smooth the cycle. Similarly, a good reason is to finance human and physical capital. Use borrowing to invest in infrastructure, but the right kind of infrastructure which has high returns, and to invest in education, which can have long-term benefits. Some countries also issue debt to build a safe asset, which underpins domestic financial market development. Among the bad reasons, unfortunately, these are common across many countries: political cycles. So every time there's an election, in the lead up to the election, you'll see a spending binge by the government to try and curry up voters. That leaves the successor government with a larger debt stock than would otherwise be the case. Sometimes, governments borrow also to limit successors' spending options. This was said, for example, Reagan in the 80s spent a lot and left the following government, the Democratic government, with a large, Reagan and Bush, with a large debt, which limited their options to spend on social and other programs. The common pool problem is important. The common pool problem is basically that every politician or every parliamentarian often has a pet project, or other people in the decision-making circle. They have a pet project. So everybody is pushing their pet spending projects, and they're very passionate about it. But nobody looks at the overall impact of that on the sovereign's creditworthiness, or the taxes that would have to be raised and the cost of those taxes on the economy, because those are spread out. So because they are spread out, nobody feels the pain that much, but the cumulative cost might be much greater than the benefit of those individual pet projects which are pushed very aggressively. The chapter also argues that the borrowing cost itself could depend on the motive. If debt finances quality investment, the R minus G on the debt can become favorable, which is that the cost can be lower, G can be higher. So borrowing is not always bad. But because we do have the problem of over borrowing, it's good to think about ways to check that. And fiscal rules and councils have been mentioned as ways to do that. I know Pakistan does have a fiscal rule at 60% of GDP. It doesn't, I think, have a fiscal council. Often budgetary institutions are more effective than rules. Rules can be violated, and that's the experience. So fiscal councils and just an auditor on the government's public finances can usually help discipline the government. The paper also looks at the debt overhang problem and whether high debt is associated with lower trend growth. And certainly, if you have high debt, you have less room for counter-cyclical fiscal policy in dealing with recessions, financial crises, and other exigencies. And Pakistan and many emerging markets are right now, with high debt, are in that position. That they're hit with a major shock, but the space to actually expand the fiscal deficit and provide support to the economy is limited. And you can then see that can translate into lower growth. And this chart here shows that real GDP growth does tend to become lower as you move into higher and higher buckets of debt. Okay, let's move on. Chapter 4 is on public debt sustainability. When does debt become too large, and how do we assess that? So there are 4 challenges involved here. One of the things that I think is attractive about the book is that it gives readers a structure to think about complex topics. And this is one example of that you break down the problem into 4 parts. You first have to define what debt sustainability is. And ultimately, it boils down to whether debt to GDP can be stabilized with feasible future primary surpluses. This is also close to the IMF's definition. If there is a path of feasible future primary surpluses that can stabilize the debt to GDP ratio, you can say that is sustainable. But if there are big question marks about the feasibility of those surpluses, then maybe that is unsustainable and a restructuring of the debt is needed. Now, once you set that concept, you immediately need to ask the question, what if the government does announce a large future primary fiscal effort? How should markets and practitioners and the citizens see that? So it raises the question of credibility of announcements on future policy adjustment promises. And here there is a large evidence on fiscal space, etc., which says that there is a limit to what governments can do, and often that depends on what they've done in the past, their reaction functions in the past. The government simply can't say, I'll run a 10% primary surplus forever. Nobody will believe that. So the credibility problem then immediately sets a cap on the kind of primary balance you can run, or the size. The third challenge is, how do you model uncertainty? Debt sustainability is a forward-looking concept. And increasingly, including in our own methods, we are trying to appeal to fan charts rather than point estimates. So rather than just project debt forward in a baseline single scenario, look at the fan chart. And this example is interesting, which basically says that Portugal, this is from the book, this on the left-hand side is the debt to GDP ratio. So 1 stands for 100% of GDP. You can see that the fan chart is quite wide and it's asymmetric. It is that means that the likelihood of debt exploding, according to this fan chart, is higher than the debt falling in the probabilistic terms. But then you can use these fan charts also to back out safe levels of debt. Because you can say, well, what if I wanted only a 5% probability that debt would exceed, say, 170% of GDP? What does that mean in terms of where debt should be today? And so you can use this fan chart in interesting ways. Then the fourth challenge is incorporating liquidity, recognizing the difficulty of separating liquidity from solvency. And that is why the country's vulnerability to market events has become increasingly important in DSA frameworks. What might seem like a temporary liquidity problem may morph into a solvency problem if it cannot be managed. And then, self-fulfilling crises, etc. You must be all familiar with that. The work that we are currently doing on the IMF debt sustainability framework, I have led that work. Our focus is usually on two variables, debt to GDP, but also on gross financing needs. How much does the government have to borrow every year? And the higher that number is, the riskier the government's position is. And in that context, I think Pakistan's GFNs have been highlighted to be high, on the high side. And the government has actually taken actions to bring it down, which is welcome. But this can be a source of vulnerability, and the shorter the duration of your debt, the higher the GFMs can be. So it's good if you have long maturity of debt, it can keep the gross financing needs low. Gross financing needs are simply the total deficit that the government has, the fiscal deficit, plus the amortization of debt in any year. So if you have a large amount of short-term debt, it will amortize every year, and then you'll have to reissue it, but it raises the risk for the government. In our work, we found that it's important that, to focus on debt carrying capacity. Countries' capacity to carry debt varies, and whether they can finance a level of GFNs. How large is their banking system? How volatile are they? These are all factors that are relevant. Let's move on. On debt management, the chapter basically says that debt management can be approached from two perspectives. One is the narrow portfolio manager perspective, which is mainly about cost-risk trade-offs. You can issue foreign currency debt at 7-8% FX rates of interest, but there is an underlying currency risk there that you bear. Versus you might be able to issue local currency debt at 12-13%, which is a higher cost in interest terms, but the risk on that is lower. So this is the traditional way in which portfolio managers or debt managers think about objectives of debt management. But when you're a wider policymaker, debt management is a slightly different animal, and you need to then think not just about your own narrow optimization problem, but also the broader economy. For example, if the government in a crisis or in a lead up to a crisis has pushed out all of its long-term debt onto the banking system, then the banking system would take a big hit. Say if the interest rates went up, then the banking system would take a big hit on that portfolio. And so you have to, or this duration risk if you push it to the bank. So what might be optimal for the government in that adverse scenario might be quite bad for the banks. And you need to think about then the financial stability implications of that. And so as a policymaker, you can't simply solve your problem and create a problem elsewhere in the economy. You have to take a total perspective. And Larry Summers has done some work in this context, how QE in the US was undermined by the longer term debt issuance in the aftermath of the global financial crisis. I want to maybe focus on a couple of points here. The chapter discusses the pros and cons of large domestic debt. That if you have a large domestically held share of debt, it's good because you have a sort of a captive market. People, the government can resort to moral suasion to ensure that banks roll over your debt. There's home bias. So it's easier to meet your financing needs. And it helps avoid a crisis. But when a crisis does ensue, domestic debt can be harder and more difficult to resolve because you basically have to inflict pain on your own citizens, which then comes back to you in terms of lower demand, lower revenues. Whereas if your debt is externally held, then at least when you restructure, you can shift the pain, externally. So there are issues there. And then there is some discussion in this chapter about how to build long-term local currency bond markets. I think something that Pakistan can also, enhance its own, bond markets. It emphasizes the importance of sound institutional setups, which sort of add transparency and predictability and build credibility with investors and serve as a disciplining device and a buffer against sudden policy changes. So, the institutional setup of debt management, and often separate debt offices, well-funded, has served countries well. There's a small quadrant in the paper which talks about demand side risk indicators, which are really, who holds your debt and your holder profile vulnerabilities, and the supply side risk, which is how high your level of debt is. And you can then bucket countries into 4 quadrants. You can have you can have high debt, but your holder structure is favorable, so you're not resilient. You're resilient to a run on your debt, but you can then have different combinations. So this is also a neat framework to think about managing solvency and liquidity risks. Maybe go on, and maybe this will be the last one where I really go into the detail, and then we'll open up for questions. This is reducing debt short of default. This is sort of connected to what I covered in chapter 1. Focuses on policies to reduce debt that do not involve a restructuring. Conventional policies are fiscal consolidation and promoting growth through structural reforms. Less orthodox strategies are monetary policy, inflation, financial repression, devaluation. All of these can inflate away the burden of local currency debt. This chapter traces the use of these in history and identifies the costs associated with it. And it concludes that it is hard to avoid the traditional medicine of fiscal adjustment, but some inflation and financial repression can help at the margin. If you overdo it, then you run into the problem I mentioned earlier, that people will not buy long-term local currency debt from you. But in small doses and combined with fiscal effort, it can actually help. But there is no one-size-fits-all here. Country specificities matter, your cyclical position, institutional quality, how open you are, all of these weigh on the choices. There are a couple of charts here from an article by Mr. Chima in Dawn from February of this year, which shows Pakistan's quite high public debt to revenue ratio and FX, foreign currency public debt in terms of exports. Pakistan among the Committee of Emerging Markets has one of these highest ratios, which suggests that there is going to be a need for revenue raising in Pakistan to bring this debt to revenue ratio a bit down, and also a competitiveness issue needs to be resolved to boost our exports so that the FX debt as a share of exports is more manageable. And these are not new things. I mean, these are well understood, but the charts make the point quite sharply. This is not in the book. This is from the article from Mr. Chima. Let's go on. And then sovereign default. This is the chapter where Raza Bakir, my former boss in the IMF, is now governor, also contributed. And it's a joint effort by lawyers and economists. It basically covers a very large spectrum of issues. It defines default, what is default, and it's not a straightforward issue. Rating agencies, lawyers, economists all perceive this question differently. And some of these questions are also coming up in the context of the debt service reduction initiative from the G20, the debt service suspension initiative of the G20, which Pakistan has also availed of. So it has a good discussion of what markets can take as default. It talks about the causes of default and also the consequences of default. And it explores why a default, on the causes, why a default might occur because of mismanagement, but also misfortune. Sometimes these things cannot be avoided. And then there are the markets that can be pitted against you. There's a change in risk sentiment globally and you're done. I mean, it's not something that you necessarily did. The wave is too large for you to manage. So it tries to lend a balance to the discussion. Often there is too much of a blame game that goes on. Governments are criticized for mismanaging the economy, when in fact it's actually mismanaged maybe 30% of the problem, but 70% is just misfortune and just a change in global sentiment. I mean, emerging markets like Pakistan are small in the scheme of global financial markets, and they're at the sort of mercy of these global waves, which if I were to approach this as a policy problem, calls for larger buffers, not having a debt structure that is too reliant on this sentiment. I think Pakistan's debt structure is not that risky, but perhaps the short-term nature of that and the large FX share are things that could be improved. It also explores the cost of default alongside potential policies that can mitigate it. There's a large evidence here that the defaults are costly. But the problem is also that if the default is necessary, if a restructuring is necessary, then if you delay it, if you get into the too little, too late situation, then it can be even more costly. Greece is the classic example, where in 2010, a lot of money was lent to Greece in the hope that it could avoid default, but it was not able to avert default. And in 2012, when the default happened, it was very large. The problem is still there. So the problem with delaying a restructuring is that you allow private creditors to escape, and you're borrowing from the IMF and the World Bank and other senior creditors, but you're letting junior creditors escape. We call this the subordination problem. So what you end up with after this sort of bailout attempt is a very senior structure of debt. And if the underlying problem is not resolved, then the country can find it really hard to borrow on the market, because prospective investors feel, goodness, this country's debt is loaded with senior creditors. If there were to be a restructuring, I'm the one who's going to be taking the 80% haircut. Nobody else is going to be, is going to have to bear the burden. So I think there are important issues here. This is why in 2016, the IMF reformed its lending framework for exceptional access programs. It said if you can have countries in three buckets, when debt is unsustainable, clearly in that case, you need a definitive debt restructuring or an official kind of concessional financing before the fund can get involved. Debt is sustainable, but not with high probability. In this case, there was a call to maintain non-IMF exposure through reprofiling, so basically lock the current creditors in as a condition for fund money, so that fund money is not used to just pay off junior creditors. It can be used to actually soften the adjustment, the fiscal adjustment. And where debt is sustainable with a high probability, the fund can provide exceptional access without any debt restructuring. So this intermediate category, which is that many emerging markets are likely to be in this zone, the gray zone as we call it. And for the fund to lend large amounts of money, we have a normal access window, but we have our exceptional access windows. And Pakistan is a normal access country. For exceptional access window, we require a reprofiling or some way to give us assurance that the creditors are not getting paid out here. Okay, maybe I can quickly go to chapter 9. So you can skip the next slide and just go to chapter 9, and I can quickly end there. This chapter, identifies the challenges ahead, and we wrote. This was written by the authors at end of 2019. But there are many issues here which are playing out today and will play out over the next few years. Firstly, the debt landscape just before COVID-19 hit could be seen as follows. For advanced economies, it was high debt, low growth, big promises on health, big promises on social spending, on pension payments, etc. For emerging markets, the big question was blurred boundaries between domestic, external, public, and private debt. The traditional approach, the traditional categories of creditors and claims is not there, and we'll look at it a little bit later. And this complicates how you deal with these different categories in a sovereign debt crisis. And in low-income countries, there are already a large number of countries at high risk of debt distress, and that would likely have gone up after COVID. Why will it be harder to resolve debt crises in the future? One is this blurred boundaries problem, that you have foreign currency debt which is held domestically. So that introduces a complication. In the past, most FX debt was held internationally. But now you have countries like Argentina, where a large part of the FX debt is held domestically. Complicates things. Local currency held abroad. So you're issuing in your own currency, but a large part is held by foreigners. So if they leave, they take the hit on the currency, but they can also leave you vulnerable in terms of financing risk and rollovers. Then you have the whole issue of private versus SOE versus government debt. Like who is issuing the debt? If one of our state-owned enterprises issues debt, is that government debt? Should the government worry about it? What about if private debt becomes very high and the government has to take it over? This is the implicit bailout promise for banks, large, too big to fail banks, etc. And then official versus private claims, which is on the other side, which is whether the creditor, when somebody lends to Pakistan or another emerging market, it might be a sovereign wealth fund. It might be a development institution which is lending commercially, but actually is a sovereign arm of lending. So the traditional distinction that we had, clear distinctions, are no longer there, and it complicates resolution, certainly for emerging markets. The other way to look at it is the creditor base. We have now a much larger share of non-Paris Club creditors, which is China, Saudi, Gulf. These are non-Paris Club creditors, have become quite important. Bondholders which are dispersed. In the past, we used to have some major banks who used to lend to countries. You could sit them around a table and discuss what to do with them. But with bondholders, they are dispersed, and it's not easy to get them to act collectively. You need collective action clauses, etc. And that's a complication. And then you have residents. Domestic debt is now a much bigger part of debt structures than it was before. And as I mentioned earlier, it's difficult to restructure the debt held by your residents because it just sort of comes back at you. If you sort of restructure debt held by banks, you can open a financial stability problem. There are other problems here as well, but maybe going towards possible solutions in the crisis prevention space, as mentioned earlier, fiscal rules, debt transparency, responsible lending, state contingent debt. State contingent debt is basically an idea. I also had the opportunity to work on this in 2017. There's a paper that I led, State Contingent Debt for Sovereigns, which basically says that your debt payoffs, the interest rate on your debt, should be linked to the debtor's capacity to pay. So think of GDP-linked bonds, commodity-linked bonds, and the idea is that your how much you pay on your debt should be linked to your capacity to pay. And this idea has not taken off in ex-ante issuance, but it has been adopted in many restructuring. For example, many Caribbean countries now have hurricane clauses in their debt. So basically, if a hurricane hits, their debt extends by a year or so. So they don't have to make that payment. It is an automatic extension under the contract. So this is one solution. Crisis resolution, like once you are in a crisis, then we need to think about use of CACs, which are collective action clauses, to get bondholders together and not get the holdout problem. Coordinated creditor fora, like some sort of a London, Paris club, standards which allow creditors to move and expect and anticipate what they're expecting, and then maybe IMF policies also need to adjust. But anyway, these are some thoughts about where the landscape is. And I'm just going to end it there. You can turn to the thank you slide, Ali. And I'm sorry if I took too long, but I thought it would be nice to give people a summary of the book. Thanks.
Absolutely. No, this was fascinating and very insightful. And while you were talking, I was thinking that almost each chapter of that deserves to be translated in Urdu and presented in Pakistan, because not only is it very relevant from a policy angle, economic policy angle, but I think it's increasingly becoming a part of the public debate as well. And the public almost needs and deserves to have a greater understanding of it. And especially the topic on which I thought was, it struck with me was the chapter on sovereign defaults. Because I remember back in time, even when I was at LUMS, I think it was Dr. Faisal Bari who Musharraf had just taken over, and he came and said in a class that the government, especially the establishment and the hawkish element in the establishment, always respond by saying that, what if we should try to default, and just to see how big is that sword of default, sovereign default, which hangs over our neck. So I suspect that this question hasn't died, and I suspect that there is an element in Pakistan who wants to understand what happens, what if scenario, that what happens if we default. And a couple of weeks ago, we hosted Mark Mobius on a webinar, and he gave the example of Argentina, and he said that debt markets have very short memories, and the experience of Latin American countries show that perhaps there's not much impact, long-term impact from defaulting. So I thought, while you were speaking, that these are such important topics which you have covered, that perhaps they should be covered in depth in Urdu. And that's why I did want this webinar to be in Urdu. But then there are a few fund managers on this webinar who are European fund managers, so they won't be able to understand. So thank you for that. We are open for Q&A. The process for asking questions is that you can write on chat. Some people have already done that. But before that, I'll pass it on to Mahmood Bukhari, who's the CEO of KSB. He has a message and to kick off. So
it is an absolute pleasure for me to meet you. Thank you so much for giving us your time today. And thank you for remembering your time at KSB fondly. I told my father, Nasir Bukhari, that you would be joining us today, and he told me to give his regards to you. I've really been enjoying your presentation, and especially the part that you've been correlating it to Pakistan. Pakistan ki bhi uske andar jo significance hai Pakistan ke liye, kaise you will bring that in, and that's really useful for me as being in Pakistan, and I'm sure a lot of our listeners. So I asked Ali Bhai to give me the opportunity to ask the first question. I wanted to ask you this: Pakistan has taken a lot of loans from China, bilateral loans from China. What is your thought process on that? How do you think that impacts Pakistan? Thank you.
Mahmood, thank you again for that kind message from Nasir Saab and yourself. Nasir Saab was really like a father to me because I had come from Lahore to Karachi, and he really took very good care of me. So I have a lot to thank him for. You ask a difficult question again. I will not be able to speak to Pakistan specifics just because of my position. I think whenever you have a decision to borrow from somewhere, you need to think about the costs and benefits of that decision, and it is helpful to have transparency in that space. Proper feasibility studies done. There are a number of things that can go wrong. This is not just a comment on any particular debt transaction, with a certain creditor. But when you are borrowing for large projects, there can be concerns around the pricing of those projects, how the projects have been valued. Sometimes creditors are able to offer seemingly low-cost financing, but the underlying project has been inflated. The price of that has been inflated by a lot. So say $100 project, but it's priced at $200, and then you get funding for the $200 at maybe 2%, but you're actually paying 4%, or higher or much higher cost. So those basic questions about what the value for money is in this borrowing need to be asked. And it's good to do them in a transparent manner. It's good to have some discipline, good to have a good debt office that does that independently. It's good to have discipline by way of fiscal councils, etc., who can come in, vet. So I think this oversight is essential. I think big creditors like China, like others, have an important role to play in financing development and infrastructure around the world. But it is also important for us to do our, job and our due diligence when we undertake large loans. Every loan that we contract is a burden on our citizens and our, future generations. So we need to be careful that we are getting a good value for money, and that the R minus G return, which I mentioned, that the cost relative to the growth benefit is favorable in respect of that borrowing. I'll just say that. Thank you.
Thank you for that. There are a lot of questions which have come. And before I ask you some of those questions, I'll just tell you as well, and also the audience, that more than 1,000 people are watching this on various Facebook pages, especially on DBTV. Thanks to DBTV and Rani Dada Boy and Habib. So the first question is that you mentioned this R minus G equation, and you highlighted the significance of G. There's generally a perception that IMF wants counter-cyclical policies, and they actually want they prescribe policies which lead to a slower G. So is this a change in IMF thinking, or is it something new?
No, I think the big lesson, I think, from the global financial crisis and the aftermath was that the Euro area crisis also was that if you try to do an aggressive fiscal consolidation in a fragile economy, it will hurt a lot, and growth can tank. And so therefore you need to do the fiscal consolidation if it is necessary to reduce debt, but perhaps the way to do it is gradually, in a more careful way on what to cut things which are not associated with high multipliers and which will not affect the economy a lot. And there's a lot of thinking that has been done in this space. But I think the perception that somehow the fund is anti-growth and pro-fiscal adjustment is not correct. The reality is that the fund often gets involved in countries when they're on the brink of a crisis, and they don't have much space to spend. They only come to the fund when they run out of money, in some sense. If they came earlier, perhaps the design and calibration of policies could be different. But if they come to us at the last minute, then the fund also has to stabilize things. And you cannot, the balance is very fine. If a country has high debt, low space, if you put a lot of money in that country and say, okay, why don't you go and spend this money and boost the economy? Markets can get nervous and say this debt is not going to be sustainable. And then the benefit that you get in terms of the G, any benefit, gets offset by the cost of the R, which will rise very sharply if markets turn against you. So you have to balance this thing carefully, this R minus G balance. If you try to go too aggressively on lifting the G, you can actually get hit harder on the R. And so that is why I think fiscal consolidation often inevitably has to be a part of the overall package where a country's sovereign is facing stress. But the pace of that, the calibration of that, the details of that matter, and this is something that the fund has emphasized, and it's actually quite important. Thanks.
Thank you for that. There are a lot of questions on Pakistan, and I'm conscious that given your role, you don't want to talk about that specifically. But if I ask a general question, and it is linked to the question which is asked, what do you think is a reasonable debt to GDP threshold for a developing country such as Pakistan? I'm just trying to phase it.
Yeah, so I think so. This is a question that we confronted, as I said, the fund has a debt sustainability framework. It's called the MACDSA, the Market Access Countries Debt Sustainability Framework. And it is being currently reviewed, and I've led that review, so I'm very familiar with this question. Our results show that there is no single magic number on debt to GDP ratio. You can have countries that go into stress at 50% of GDP, even 40% of GDP, and you can have countries that can withstand much higher levels of debt, even above 100% of GDP. And there are some emerging markets which report debts above 100% of GDP, and therefore, in Brazil has very high debt, Egypt, Jordan, and so clearly, the higher your debt risks to increase, but there is no magic number. What matters is a couple of things. What's the institutional capacity of the country to manage that debt? If the country has, what's the structure of debt? Is it mostly FX, which then raises the risks, or mostly local currency long term, which means that there isn't a funding crisis that is imminent? And then, we also focus a lot on gross financing needs. What's the annual amount that the government has to borrow from the markets, which brings in the maturity structure of debt. If your gross financing needs are manageable, given the size of your domestic investor base. So if a country has a large banking system, which doesn't have a major exposure to the government, then if the government in a crisis needed to borrow more and raise debt, the markets would finance it. The banking system would be able to finance it. But if your banks are very highly exposed to government already, and they are small, the balance sheets are small, and if the government wanted to raise its debt, then it may actually find that it cannot do it and runs into a liquidity problem. So I think this issue I mentioned earlier, debt carrying capacity and financeability of gross financing needs are key things to focus on, and there are a number of factors behind it. So there's no magic number so far. And in our current framework, the fund uses a benchmark of 70% of GDP for emerging markets, but it's used as an indicative, number. As I mentioned, that the evidence suggests that there is no single magic number, and we have to be cautious about it, actually. Thanks.
Well, thank you for that. There are, again, a lot of Pakistan-specific questions, which I just want to avoid, just given that you said that you don't want to comment on it, and you want to focus on and you can speak from a book perspective. But again, if I generalize, when there's a perception, of course, and I'm assuming this is a global perception, that they see IMF as a bank, and clearly as a bank, they think that the policy advice which IMF gives is primarily geared towards getting the money back, which a bank would typically do. So the question is that the growth framework, the G which you're talking about, is it primarily, do you look at it primarily from a perspective of debt sustainability, that how much growth is sufficient for a country to pay back the debt? Or do you look at it from a more larger perspective?
So I think IMF as a bank is too simple a statement. The fund is the sort of lender of last resort for the global financial system, certainly for emerging markets. And so it performs the function that a central bank performs inside a country is the function that the IMF performs internationally vis-a-vis the central banks in order to keep the financial system, the monetary system going. And the fund's preferred creditor status it actually derives from that lender of last resort function. That if the fund did not have assurance that it would be paid back before other creditors, it would not come in when everybody else is running for the exits. We come in at a time when markets don't lend, official bilateral creditors need assurance. And so because we come in at that time, there's the fund's preferred creditor status has been accepted in that light. But I mean, it is also clear if on this question of growth versus fiscal, etc., it's also clear that if we went in and said, well, under this program, you'll have to do a massive fiscal consolidation. And that fiscal consolidation kills the economy. That's not going to strengthen prospects for repayment of the IMF debt either. So you have to, strike this right balance between growth and keeping, preserving market confidence. And the fiscal in that respect has to be calibrated carefully. It can't be, obviously you can't expand too much to lose market confidence, but you can't also aggressively contract in a fragile economy. And so this balance between how much financing we provide, how much contribution comes from other creditors. And this is where the whole issue of, the gray zone cases that I mentioned, that in our larger access window, the fund in 2016 said we would want actually the private sector to maintain their exposure before we come in, because what that does is it expands the pool of resources that is available then to soften the restructuring. Otherwise, every dollar we put in goes out the door to the market, to the private creditors. Whereas if the private creditor exposure is locked in, then the fund money can be used to soften the adjustment. Thanks.
Thank you. And there are a lot of questions, but maybe the last question, given the time we had asked you for 1 hour, and we've run out of that. There's a question from Taha Javed from Mizan Asset Management, that in your book, did you look at corruption and project overruns on the infrastructure side as having an impact on the overall debt burden of a country?
No, we did not look at that. I mean, obviously, I didn't write the chapters, the authors did. But the chapter on why governments borrow, or why the motive to borrow, does discuss, I think, indirectly this issue. I think there is more work in this space. I mean, it talks about borrowing and infrastructure and good and bad reasons to borrow, and if there is corruption and governance lapses, then it can lead to over borrowing in the system, because there can be cuts related to that borrowing or that projects. So I think those are indirectly covered, but not directly. We have a governance. The World Bank and the IMF do work on governance and corruption, and you should certainly look that up, and you'll find some answers there.
Thank you so much. This was extremely insightful. There are a lot of positive comments and thanks on the chat channel, and I'll share that with you. And then just a observation and a comment from me to you, and then also maybe in your new role as IMF Mission Chief for Jordan. And also for the few people, I think there were some people from State Bank on the call, that I do feel that a lot of these topics and the answers are not available to general public because we keep it in English. And in the case of Pakistan, and we have seen that in our work at KSB, that the outreach and the reach with English is much more restricted compared to in Urdu. Whatever we paste in Urdu and whatever we develop in local languages gets far greater pickup on digital media than English does. So I think that the content of this book and the content which you've discussed in this presentation is so important that I think I would recommend you to produce and translate it in Urdu as well, and for the audience in Pakistan.
Yeah, I think maybe a translation of the full chapters may be too much, but let me talk to Oxford University Press and others if they could do sort of a mini version, a summary version of it, the distilled wisdom of each chapter, and short articles around that could be maybe, because some of the equations and other things can be complex to translate, but the wisdom of that, the essence of that, can actually be captured. But I may need your support for that too.
No, I would love to help. And I told you we launched an online MOOC, and half of it is in Urdu, precisely for that reason. We just launched a webinar series in Sindhi. We want to do the same thing in Pashto. And I know that State Bank and SECP are always running investor education events and campaigns, but I've seen that they're all in English, which I suspect doesn't really reach a lot of people. And given IMF is, and then this IMF's role is so paramount and critical, and the debate on that is so hot and heated, that perhaps a lot of these issues need to be just explained to people in a language which they can understand.
Understood.
And I would love to help you in that. And thank you so much for your time.
Thank you, Ali. You know, as a token of my appreciation as well, I will send you a few books, complimentary copies, but sometime in July, which you can then distribute to people that you think would benefit from them, either in the policy circles or in market professionals. But this will happen in July. I'll send you a few copies to distribute. Thank you.
That's very kind of you. Thank you. And I will distribute it in post-August once I can go to Pakistan. So,
All right. Thank you, Ali, for that.
Thank you. Take care.